Hello and welcome to Milestones in Business. I'm your host Dave Coult, and today we have our guest John Zayaitz. John's a certified public accountant with Campbell, Rappold & Urasitz, a large accounting firm in the greater Lehigh Valley that's been in business for over 93 years, so very impressive. And I know John works with a lot of construction businesses, business owners in general, across different industries, but has a lot of clients in the construction trades. And so I wanted to ask John, what would you say is the number one key to success in building a construction company?
Well, Dave, thank you. In any business, certainly the key to success is understanding the dollars and where they come from, and that's driven from the margins, what you're billing, less your direct costs, and the ability to get to the break-even point, and what we call scale. And that scale is very pertinent and will drive the financial ratios of any successful business and allow for the margin to grow. It'll allow for the growth of the strength of the company, and it provides the resources for the company to make decisions that will be pertinent to future success for everyone in the firm, including the business owner.
So how does a business owner evaluate the margins that they're running on projects, and how do they determine whether they've gotten to scale?
Yeah. So in construction, most of you know that we have a very good handle on what we're charging or what we're bidding a project based on what we expect our direct labor input to be. Commonly the T&M model, the time and material model, the plus 15 or 10 or 20, whatever it may be, it is a very good example of what a margin is, right? That additional 10-20% is what you're making on that job. And that's true in anything that's bid, right? And as we job cost, we're keeping track of every day, at least every week, and as we're submitting AIA reporting or just job track costing in general, we know as business owners what we've made on each job. And that's really our margin, which contributes and provides the revenue to support the rest of the business. And once the rest of the business is paid for, think of the rent, the utilities, your office admin, even your own salary. Once those have been covered, we've got scale. And anything above scale, any additional business that's generated above that break even, now we've been able to pay ourselves as the owners.
That's great. I know one of the challenges that can be unique to construction companies is the cash flow, and the challenge of laying out a lot of time and labor and materials into a project and often having to wait a long time to get paid, and the challenge of getting paid. What advice do you give to companies that are dealing with that challenge, and how should they respond when they do finally get the cash that they've been waiting for?
Sure, yeah, not unique to anybody, but certainly it's under a magnifying glass in the construction world. We have jobs that are ongoing and closing and starting and stopping, and each one of those may be more profitable or less profitable than the other. So we have some winners and losers. And once we understand what revenue we need for the overall year, we've got these possible and hopefully surpluses of cash. And so we wind up with chunks of money coming in, and whether they're in thousands or tens of thousands or hundreds of thousands, we wind up with them throughout the year. And it's important for the business owner, for you running your construction company, to not say, okay, let's go out and buy something new. It's what do we do with that money? Where does it need to go first and foremost, right? We have an extra $10,000 of profit, $100,000 of profit. Some part of that's going to be a tax burden. We know that. Let's set that aside. Next, we need a conversation across the board with everybody to plan, maybe not by job, but in total. And our financial advisor is key to that plan. With your internal and with your external accounting support, to decide, okay, what do we need to spend on our future capital, equipment, employees, how much of that needs to go to savings, bonus plans, retirement plans, performance, safety bonus plans, all those things come into play. So it's really determining where that cash needs to go and should go, not what toy we should buy.
I think that's a good way to put it. And one of the things that we try to make an effort to do with clients that we work with is to talk with the team of advisors. So get the business owner talking with their internal and external accounting professionals, as well as us as a financial planning team, to make sure that we're coordinating our efforts and we're all on the same page in accomplishing the goals that they have both within the business and for the business owner as well.
That's great.
John, as an expert in accounting, some of the unique challenges that construction business owners face with seasonality being an issue that they have to deal with, freezing and thawing in cold weather seasons as well as warm, overlaid with the cyclicality of the construction business, either in rapid expansion or rapid contraction, as we've seen in the past here. How do you help them address that, and what suggestions do you have for business owners in dealing with that?
Yes, certainly in Pennsylvania, we're not dealing with a warm southern landscaping company that has grass growing 12 months of the year. There's ebbs and flows, and certainly construction generally picks up in the spring and falls off in the fall. But being able to build a business that adapts to that as best that we can is important in the construction world. And so we look for things and areas of opportunity that can provide ongoing, reoccurring revenue. We look at maintenance contracts, service contracts, taking deposits and ways to generate revenue that'll be continuing and ongoing. And the second part, when we go back to the first question that we answered, understanding where our billing can be to possibly win those jobs, with lowering our margins in those times when demand is maybe lower, to ensure that we've covered our costs during that time. And so if you think of, we've made our break even maybe mid-year, let's call it August, September, and we're able to take on a job at a lower margin, maybe half or maybe 2/3 of what we normally do. Again, use an example, say it's a $50,000 job that we're used to getting 30% on. Well, maybe we get 15%, and we've not had to pay a lot of costs, and we've been able to retain our employees, and at the end of the day, you as the business owner has wound up with some money in your pocket. And you say, oh, that's really easier said than done. So how do you do that? Well, and certainly one thing we want to avoid is getting stuck with those bigger contracts in the expectation that they were going to be started in the fall, but they get pushed out till spring. So you want to take on things smart. If you're going to change your margin structure, certainly that's a big time to not extend yourself too much, but to take on those smaller jobs, the ones that are more manageable. We'll say the easy ones, where maybe you'd love to push them out till spring, maybe next June or July, but whoever's paying you is not willing to take on that risk or wait that long to get completion. And then the other thing is looking for industries that maybe support that ongoing revenue, whether it's a governmental type municipality, or just a smaller business that maybe has a continual need, as opposed to that once every 15-year type building need.